With markets continuing to shift and economic headlines coming from every direction, investors are looking for clarity on what really matters right now. From the overall health of the Canadian economy to changing financial conditions across North America, there's no shortage of uncertainty and opportunity. To help us cut through the noise and better understand what could be ahead, we're joined now by Brendan Caldwell, Director of Caldwell Securities Limited. Brendan, as always, thank you for the time.
Well, thank you. I take it from your lead in, inflation isn't up very much unless you need to eat. Um, so yeah, we can start unpacking that, Theresa. You go right ahead.
Well, let's talk about the determining factor. What does this mean when you're investing?
Really, interest rates are the determining factor because interest rates are the price of money. It's what it costs to have access to money. And the higher interest rates are, the higher the price for anything is. Interest rates are the measure for that cost. So the higher interest rates are, it is true with anything, the demand will be less. So higher interest rates, less demand, lower interest rates, greater demand. At least that's the theory. So that if they crank up interest rates from the Bank of Canada, which your lead interview guest was talking about the governor of the Bank of Canada and his relative anonymity. I think that's probably a good thing. To the extent central bankers become political figures, what could possibly go wrong? Mark Carney, call your office. So the central banks have the ability to adjust short-term rates, specifically the rates to which they lend to the commercial banks, which then impacts the prime rate and the short-term borrowing rates. So they have the biggest impact in that area. And generally speaking, it's one of the tools that the central banks use to either make money more available when the economy is slow and less available when the economy begins to heat up. So when they're trying to slow down the economy, they'll raise interest rates. When they're trying to rejuvenate it, they'll lower interest rates. At least that's the theory. The issue both here and south of the border that we've seen is that rates have been lowered, at least in part, for political reasons. And when that happens, it doesn't get reflected in the consumer price index, which is the numbers that came out this morning. Where you see that reflected is in asset inflation. And although your leading guest was talking about how inflation hadn't been very high for the last 20 odd, 30 odd years, he's really talking about the prices of goods and services, everything from food to rental costs to energy. What has gone up is asset prices. If you keep interest rates low, some of that may trickle down to the main street. Maybe somebody builds a plant. But generally speaking, shorter term rates don't determine longer term investments when it comes to illiquid investments like plant and equipment. What it does tend to trigger is more investments in, stocks and real estate and other capital intensive investments. So you'll see asset inflation, which we've seen for the last 30 plus years when interest rates are low. So they've been cutting rates, particularly in the US, because the president's been putting a lot of pressure on the Federal Reserve, the US central bank, to cut rates. Likely in May of next year, he's going to put a central banker, chairman of the US Federal Reserve, more to his liking, more inclined to have lower rates. So I think it'll be for investors, the determining factor will be interest rates. And I think at least short-term interest rates should remain lower for longer.
And in your opinion, is the Canadian economy strong?
No, no, I mean, depends how you measure it, but essentially no. And at the very least, it's not nearly as strong as it should be. Now, it's a trap of resource-based economies that they stay resource-based economies. Most of the really dynamic economies in the world are a little bit shy of resources. I mean, the US's prosperity is not based on its tremendous resources, although it's a big country and it has a fair amount of lots of things. It's not really a resource economy the way that Canada has been. A resource economy tends to be much more subject to macro global economic forces, but it's also subject to local political forces. And in Canada, we've been remiss in the development of the resources we do have. And also, we've been probably over reliant on them, energy being the biggest one, to the expense of really building up industrial or technology companies that are world beaters. We don't even have that many resource companies that are world beaters where we're the takeover or rather than the takeover E. And head offices matter. I mean, Toronto is as prosperous as it is because it has so many head offices here. Merely having resources without the mind and the decision making that for the deployment of resources isn't a formula for prosperity the way having a head office is. So yeah, Canadian economy isn't doing as well as it could be, and it's certainly not doing as well as it is relative to our neighbors south of the border.
Now, you've already talked about this a little bit, but let's switch back to interest rates. Um,
Mhm.
do you see them coming down in Canada, or what are we looking at right now?
I don't know there'll be interest rate cuts, although the inflation rate, the core inflation rate was a little bit lower than people
Mhm.
expected, and well within the range. But the price of food, as was noted, is up tremendously. And I must push back a little bit on your entry with your entry guest who said, "Well, it's just that 1 year." But every inflation number that's happened since the one balloon year a couple years back in inflation, every increase in inflation is off that bigger number. And he's right in this much: people's wages haven't kept up, um, which is a sign that corporate profitability hasn't kept up, which is a sign that individual productivity hasn't kept up. So there's a lot of factors there, but the short answer is wages aren't going up 4.7%. And for some large percentage of Canadians, I mean, our food bank, the Avenue Road Food Bank at Avenue Road in DuPont, when we opened that in 2018, we served maybe 80 families a week. Now we now serve 500 families a week. The price of food is a determining factor in a way that it hasn't been, I would say, since the Depression, but I don't think there were 500 person lineups, that 1,000 family lineups, 1,000 people represented by that anywhere in the city, even in the Depression. So the price of food is a really big issue here. So I don't know that they're going to cut interest rates more because that may feed inflation to a greater degree without necessarily helping the people that earn wages.
And in the United States, what are their interest rates looking like? I mean, are they also struggling with food prices?
Well, they are, but their productivity has been generally greater. Food and accommodation have been both issues in the US, but they have this one advantage: their temperature is generally warmer. We simply have to burn more calories to stay alive. Um, in the United States, they have a few more options and they have a more dynamic economy. I expect their interest rates are going to come lower, not for economic reasons, but for political reasons. I expect that will continue to fuel in the price of investment assets, particularly the stock market. I do not see the stock market having a long-term pullback anytime soon. In other words, I see the current expansion, if you want to use the term bubble, I see the current bubble continuing.
Well, Brendan, thank you for the time. We appreciate it.
Thank you, Theresa.